welcome to our third webinar in the series of webinars on the risk allocation framework in transfer pricing, hosted by Amsterdam Center for Transfer Pricing and Income Allocation of the University of Amsterdam. Today, we would like to bring to your attention two excellent presentations by Emmanuel Llinares and Rutger Hafkenscheid. And also the webinar will be moderated by Rezan Oktan. And my role is pretty limited today, just to introduce our excellent speakers and the moderator. And today's topic will be an economist perspective on the risk control framework and how to build a coherent risk and value chain analysis transfer pricing model and support the risk allocation with the company's financial data. So we will deal with quite practical issues that many transfer pricing experts and also in industry tax professionals face in their daily work. And please allow me to give the floor to Rezan, then to introduce our speakers today.
Thank you, Svetlana. Hello, everybody, and welcome to the third session of our webinar series about risk allocation framework and transfer pricing. We started off with a more general session, hearing from the OECD academia and the advisory world as to how the risk framework should be viewed at a high level. In our second session, we looked at the US and Brazil in terms of how they could be different from the OECD approach. And these two sessions focus more on qualitative aspects of risk framework. What we will do today is somewhat different. We will go one step further and discuss the risk framework from a quantitative perspective. And then, risk, generally speaking, is about probabilities, possibilities, and uncertainties about what you could expect in the future. Of course, it's extremely helpful to have a good feeling about what risk is from a qualitative perspective. However, without doing a quantitative analysis, the assessment remains highly subjective and also prone to personal interpretation. It is therefore for no reasons that some of the most successful investors in the history have based their analysis on quantitative analysis. Take Ray Dalio, one of my personal favorites in investing, from Bridgewater Associates, who, thanks to his quantitative-based risk models, predicted the financial crisis of 2008 and 9. Another example is Warren Buffett, who pays a lot of attention to what numbers basically tell us. Well, you get my point. Risk quantification is very important for many matters, but certainly also for transfer pricing purposes. Therefore, we have two excellent speakers lined up who have done a lot about this in the past, and I will start with their introduction. But firstly, a little bit about myself. My name is Rezan Oktan. I will moderate today's session. I've been working in transfer pricing my entire career, which is about 16 years. I started at Big Four, later on went in-house, where I also have seen how important it is to do quantitative analysis, especially for implementation purposes. And since last 4 years, I'm working at Houthoff, heading the transfer pricing practice. I'm also a fellow at the University of Amsterdam and co-director of the Amsterdam Center of Transfer Pricing and Income Allocation. Our first speaker, Emmanuel Llinares, who will talk about different risk categories from a business perspective and basically risk analytical framework for value chain purposes. Emmanuel is an economist by background, has over 20 years of experience, having worked at Arthur Andersen, KPMG, and currently chair of NERA's global transfer pricing practice. Our second speaker is Rutger Hafkenscheid. Rutger will tell us more about the relationship between risk and the expected return and how to quantify risks for transfer pricing purposes. And he will do that through a case study, which I'm sure you will very much appreciate. A few words about Rutger. He has an impressive career spanning over 30 years. He has worked for the government, Big Four, most recently for one of the largest law firms in the Netherlands called Loyens & Loeff, and he's currently a partner at the boutique consultancy firm Hafkenscheid, which he established with a few companions of him. Rutger is also an amateur jazz guitarist, which I found very interesting personally. Before I hand the word over to Emmanuel, let me briefly refresh our memory about the relevance of risk analysis for transfer pricing purposes, so that you can make the connection a bit easier. Risk analysis, as you may know, is part of a function analysis. In fact, when you look at the OECD guidelines, one of the 5 comparability factors refers to function analysis, and function analysis says, well, look at the functions performed by the parties and also take into account risks and assets. Well, the way it was written, it was kind of, risks were not that important. You should focus on functions. It was a bit on the back burner. And in fact, in practice, unfortunately, that was how it was done as well. Especially tax lawyers focused more on contractual risk allocation and not so much about how the risks were managed. With the BEPS project, and especially starting in 2010 with the new OECD guidelines, including a chapter on business structuring, control over risk concept was introduced. In the PE report of OECD, reference was made to the fact that risk should follow functions. That was kind of the initial stages of risk becoming more important. And as part of the BEPS project, OECD has introduced this 6-step risk analysis process. And the third step in the risk analysis is function analysis, which is kind of strange because in the risk analysis, the order is kind of reversed. You look at the risks, but you need to do a functional analysis in relation to that risk. And doing that, you have to look at the control of management and risk, and also the financial capacity, and with our financial capacity to the cost and the funding and so on. This is, I think, sufficient for now. Let me now hand the word to Emmanuel to start his presentation.
Thank you very much, Ghassan. I'm going to share my screen. Hopefully you see my screen now. So what I'm going to talk about today is an analytical approach that we have developed over the years, we at NERA. And in fact, some of what I'm presenting it today is what was shown, what I had the pleasure and the opportunity to show at the OECD back in 2014, when the transfer pricing team at the OECD was working on this revision of Chapter 1, dealing with risk. So I'm not saying that some of that made its way to the guidelines. It's hard to be in the heads of who drafted the guidelines, but all I'm trying to say is that there is some of that is not completely foreign to what we saw in the guidelines in 2017. So in particular, what I will be talking about is a couple of definitions to explain what's behind this on risk and the enterprise. And then I'll spend a bit of time on what I call the enterprise view of risk. And it's really the relationship between risks, volatility, and the impact of volatility. Once we would have developed these first 2 parts, which are sort of conceptual, then I'll sort of talk about how all of these play in the transfer pricing framework. And going back to what Ghassan was saying, how do you link the risk with the broader value chain analysis, ultimately to make decisions about what is the suitable transfer pricing policy? So let me start with a few concepts here. First of all, I think all businesses operate in a world of volatility. It is their strategic choices that expose them to specific types of volatility. In a way, accepting and managing risks is the essence of an enterprise. You could view this: an enterprise accept or is in a business. As a result of that, it faces a certain number of risks. Okay, and when it accepts that, its view obviously is to generate profits and therefore secure its continuity. Combine these 2 terms, profits and continuity, that links to value. I'll get back to that in a few minutes, because to me, that's directly linked to the concept of value chain analysis and value creation. Now, in a multinational enterprise, risk management is about dealing with the impact of volatility on profits. Doing so means that you're able to identify the source of volatility and assess the impact of volatility on business. The impact of volatility, what I mean by that is obviously the downside effect. And that's when people talk about risk, they are often almost solely focused on the downside impact of risks. But some of these risks also have upside potential. I mean, financial risk is a classic one. Depending on the way the foreign exchange rates goes, you could win or you could lose. So you can see that a risk is not only downside, some risks at least have an upside potential. So prior to getting into the link between volatility risk and their impact, I thought it would be helpful first to consider the different categories of risk. Here, and you'll see some resemblance to the OECD, but it's not exactly the same. Here we've got 5 categories of risks. We broke this down into 5 categories. The first one is called strategic risks. I think the OECD refers to strategic and marketplace risks, so I'm calling this strategic risk here. What is this? These are the external risks which can offer significant downside potential if the competition, the market environment, regulatory events, etc. But if a company can recognize such changes when they are just beginning to occur, it can differentiate itself, and the change can be turned into a huge competitive advantage. That's the upside potential. So clearly for strategic risk, you see both the downside impact if you got it wrong, and the upside potentials if you got it right or on time. The second category of risk that I have here is called intellectual capital risk. And that in my mind also includes human capital risks. These risks arise from challenges related to a company's talent, leadership, and its choices to differentiate itself from competitors. Of course, the related intellectual and human capital systems are key to realizing the promises of the strategic choices. Failure to manage those risks has a negative impact on continuity. In a way, these risks are not explicitly recognized in the OECD guidelines. In my mind, most of what we're talking about here can be sort of grouped under what the OECD refers to as strategic and marketplace risk or operational risk. This is one of these 2 categories that you would find most of these. But I think it's a bit of it can be interesting to have these risks as a standalone part, because to me, they are clearly distinguishable from strategic risks and operational risks. But the OECD didn't leave that door open, so let's break them down into these 2 categories. The third category, financial risk, takes the form of fluctuations in financial market prices, which can have a negative or positive impact. So again, here you see clearly that these are risks which have both downside potential and upside potential. The fourth category, and by the way, financial risks made their way as is to the OECD guidelines. You find that concept in there. In the OECD guideline, they've added these transactional risks. For the sake of this presentation, I'm not distinguishing between transactional and financial risks. To me, it's the same broad categories of risk, and I talk about this as financial risks. The fourth category is operational risks. These, for example, can relate to internal process breakdown, which can have significant impact on a company's supply chain, customer service, or manufacturing operations. So as you can see, when it comes to operational risk, it starts to be mostly on the downside impact. But again, my view is that if a company does this better than others, it's better than the market at managing operational risk. It could have obviously a form of upside there. The last category is what is referred to as hazard risk. These are risks which arise from adverse external events, and that may result in property damages or and liabilities. They usually have almost exclusively a downside impact. There is limited upside here. My view is that these are the type of risks that you try to insure away on insurance market or try to outsource in one way, shape, or form. They are not at the heart of the value proposition of most multinational enterprises, so they tend to be managed away. So these are my 5 categories of risk. With these 5 categories of risk in mind, let's now look at the risk and volatility paradigm. What I've done on this slide is 2 axes. On the horizontal axis, I've got the source of volatility. On the left-hand side, it is an external source. On the right-hand side, it is an internal source. On the vertical axis, I have the impact of volatility. At the bottom is a downside impact. At the top, it's an upside impact. And what I'm going to do here is just sort of place each of the risk categories we just talked about on the previous page, place that on this chart. Let's start with the easy one. That's the hazard risk. Okay, so hazard risk, as we said, largely external source of volatility. It is an external risk, and the impact of volatility is mostly a downside. As a result, I'm going to put this in the lower left-hand side corner. Let's now move on to operational risks. Well, operational risk is mostly an internal source of risk and largely downside impact, limited upside. Okay, so as a result, I'm going to put this closer to the right, but still towards the bottom of the chart because it's mostly a downside impact and not much upside impact. Now moving on to financial risks. Financial risks, think about financial markets mostly, so interest rates fluctuations, foreign exchange rate fluctuations, and these kind of things. So here, as we've talked about, it can have both an upside impact and a downside impact. It's mostly an external source of volatility. So I'm going to put this towards the middle. It can go up and down and more to the left-hand side than to the right-hand side because it's mostly an external source of risk. Fourth, the human and intellectual capital risks. Now here, it's very largely internal, almost exclusively internal on this one. And again, it's about the people, it's about the ability to maintain valuable intellectual capital. That, in my mind, has both upside and downside potential. And I put that towards the middle as well, but more on the right-hand side because the source of that risk, the source of volatility here is mostly internal. Finally, I turn to the strategic risks. These are risks that are at the heart of the value proposition of the company. The company is in business, in a specific business, it mechanically faces those strategic risks. If it doesn't want to face those risks, either it's doing drastic changes to the market it serves itself, or it's just getting out of that market. But there is no way that you can insure any of this away, obviously. Okay, the strategic risk is largely an external source of volatility and significant upside potential. There is some downside as well, but when you think about strategic risk, hopefully you're in for the long run, and it's the upside that you're looking at. Okay, I think it's important that that chart helps, in my mind, because it sort of sets the link between the risks and value creation. And what we've done is we've drawn a line from the top left-hand side to the bottom right-hand side, and basically above that line, these are risks that are at the heart. They are core business risks at the heart of the value creation, and it's very hard to diversify them away. I mean, you're in business, you assume those risks, you got little way out. You can do a better job than others at managing them, but you can't diversify them away. You can't call your insurance, say, look, I want to price this risk out, can you help me out? That's no insurance company would be able to do anything for you here. That's the contrary to what you see at the bottom left. Obviously, as always, most companies would probably go on the insurance market or find some solutions to get those risks away because they are not at the heart of the value proposition, and hence you wouldn't want to focus overly on these risks when thinking about continuity of the business. You want just to prevent the downside impact. That's all you're wanting. With that in mind, what I thought we would do now is sort of think about how we can make the link between this risk analytical framework and the broader value chain analysis. What I'm going to describe now is an analytical process, the purpose of which is to understand how value is being created in the enterprise, how individual entities take part in the joint process of creating value, what their respective contributions are, and how each of them operates and carries responsibilities for the relevant types of risks. Ultimately, it is those elements that drive the entitlement to parts of the profits of the individual entity. The way in which they carry part of the risk in the enterprise decides not only the level of remuneration that they should earn, but also its dynamics, the evolution over time of this remuneration. Ultimately, risk management is about dealing with the impact of volatility. So let's see how I can frame the risk concept I've just described into a broader concept of value chain analysis. When we do value chain analysis, the first step is actually to identify the value drivers. A value chain analysis is about understanding, in addition to the analysis of functions, how value is being created in the enterprise. in my mind, it is about identifying, if you will, meta functions. But to do that, it's essential to understand the key value drivers, that is to say, the drivers that have the most influence on the critical success factors of the enterprise within its industry. As part of that, it's important to identify the key value drivers in the value chain, which can be held accountable for the enterprise major risks within the industry and given the multinational's own business model. So the link, you see immediately that I'm already sort of displaying the link between critical success factors, critical risk, major risks, and value drivers. Once I've identified this, I'm clear about what the key value drivers are. I'm going to then try to be a bit more sophisticated or more precise, I should say, and to map the functions, the assets and risk of the enterprise to these value drivers. For the sake of clarity, this chart is super simplified. I've got 5 value drivers. It's here, I've made it relatively easy to map the functions of the enterprise to the value drivers. The picture sometimes is much more blurred. Same for risk. I oversimplified to make it graphically presentable. And I'm assuming that the strategic risk, there are only 2 kinds of risk I'm dealing with here. Strategic risk, which are on the left-hand side, mostly associated with value drivers 1 and 2, and operational risk, which are on the right-hand side, mostly associated with value drivers 3, 4, and 5. So again, very simple, very simplified. In most cases, the picture will be more blurred, and I would expect that with value drivers 1 and functions, some categories of functions, you would have risks that could play, you could have various categories of risks. I do the same for intangibles. You sort of try to get the link between the value drivers, the functions, and the assets. And so link these 2 together. Again, here, oversimplified. I've got technology and tangible on the upstream value drivers and marketing intangibles on the downstream value drivers. It's not often that clear in real life, but it gives you a picture of what I'm trying to do. Again, it's just to map the functions of the enterprise as a whole, not a specific legal entity, to the value chains, but also map the assets and risk of the company as a whole to the value driver. Okay? Only once I have that picture, then I can go to the specific roles of legal entities or entities. Okay, so at the end of that process, it's step 3 here. Only there I sort of say, okay, what does this specific entity, where is it positioned in the value chain? And by the way, it could be positioned across several places here across the value chain. But that process to me comes later. Once first you got the big picture, and then only you sort of say, okay, by the way, that specific legal entity we're talking about here actually plays here only in value driver 5, and the only risk sort of it can be held accountable for of this one and this one. And same for the intangible. This is the kind of intangible it relies upon, and this may or may not be the intangible that it contributes to developing. At the end of that 3rd step, one of the things that could be helpful is to, instead of having the classic routine entrepreneur distinction, maybe we can be a bit more subtle and break down the role of entities into 5 categories instead of just 2. So I think it's a bit more sophisticated and more precise, I would say. So here what we've done is sort of laid out 5 functional profiles. The first functional profile is called an investment center. This is a profit center, but a profit center which is also responsible for investing in new products, services, or work processes in order to enhance the future profitability. It assumes responsibility for the continuity of the enterprise. So I'm not saying it's the HQ, that's not what I'm saying, but I'm saying it's not just a simple profit center, it's more than that. It has responsibility for the continuity of the enterprise. So you can make the link immediately here with the strategic risk and the core intangibles. To me, that's what this concept is about. An investment center probably has a significant role to play with regards to the core intangibles of the group and the core strategic and operational risk of the group. It probably plays a role there. Profit center is actually simpler. Yes, it's responsible for achieving maximum profit by increasing revenue and or decreasing cost, but typically over a certain period of time, and it doesn't have that responsibility for the continuity of the enterprise. So to me, it's a little different from the investment center. The revenue center is your classic sales organization, so I'll go briefly on that. Your cost center is your classic sort of manufacturing center, the service provider center. Again, not much here other than when I talk about a cost center, there is a direct relationship between cost and output, right? So that relationship is relatively easy to measure in this circumstance. And that's going to be the difference with the expense center, where yes, there is responsibility for delivering certain outputs according to quality specifications, but it's much more, the link between the inputs and the output is much less quantifiable. So expense centers, think about this as R&D. That's the prime example of expense center. You can spend tons of R&D and get fabulous output. We can spend the same amount of R&D and get no valuable output. That's the link between the amount you spend and what you get out of it is much more volatile, I would say. Okay, so again, expense center could be linked to some core intangibles. It could be linked also to some strategic and core operational risks. Ultimately, I'm doing all this because I think it's a lot more subtle than the routine entrepreneur distinction. And I think it does a better job at helping you identify which key functions have control over which key risks. I think when you use that matrix here, it's a lot easier to map the roles and responsibilities of entities to the risk they can be held accountable for. At the end of this process, I'm not doing all this for the pleasure of filling in a large master file. That's not the objective here. It's not the sole objective. The key point is to understand the relationships, and by that I mean the transactions. Indeed, the transactions within the multinational enterprise are the expressions of those relationships. What I want to do is use the framework I've developed to be in a better position to determine what is the relevant pricing for my related party transactions. This means I need to understand not only how prices are set ex post, but also ex ante. That's what I want to understand here. In my mind, when you look at risk, the ex post outcome can only be understood and explained in light of the responsibilities of group entities for different risks and the way they are supporting and capable of supporting those risks. In the end, so as I said, we're not just testing outcome here, we're trying to understand what's at the origin of risk and how the transfer pricing policy should be designed given the risk that each entity can and should be supporting. Yes, we can make reference to external transactions or to comparables or to the way people on the market would behave, provided this is in similar relationships. So in a way, this four-step process, if I position this in a transfer pricing context, it helps me better understand the transactions, but I can only do that because I've got a holistic view of not only the functions and the responsibility of the core entities, but I link that with the assets and risks through the steps I have developed. That should help me not only decide what are the relevant transactions, but which method I can also apply and how I might be able to apply these methods to price the related party transactions. In the end, the concept we've developed at the beginning of this presentation, the enterprise view of risk, can be very helpful in analyzing risk. And what I like about this, it's sort of talk about risk with a direct link to the value chain analysis. Again, think about the risks that are often overlooked, notably the strategic and marketplace risks. Well, that matrix forces you to take a look at those risks very closely and try to see who's accountable, who may be held responsible for these risks. And that responsibility, the control over risk within the total value chain should be the basis for the assessment of the entitlement to the fruits of the joint activities, that is to say, to the allocation of profits, I'm talking about long-term profits here, to each of these entities. That concludes my presentation. I believe, Rezan and Rutger, we can take a few minutes now for questions.
Yes, thank you, Emmanuel. It was very well explained. Very logical process, well structured, well thought through. One of the questions I have, and having also, as I said, being in-house, I always found difficult to make the connection. Well, when you start with value creation, value drivers is kind of easy. You know, you speak to the business, they understand the language that you're speaking, you identify them. You need to have some explanation, but eventually you come to that. Then you can link the functions to the value drivers as well, because most of the time, you know, the organizational chart is in line with how the value drivers are kind of understood by the business. However, when you come to the risk, you come to both functions, but you come to the costs as well. And I always found difficult, how do you make that link, especially when you deal with so many different types of business models? Basically, how do you do that in practice?
Thanks for this. So there's no magic here. When we start with these analysis here, sort of comprehensive value chain analysis, which include a lot of time being spent on identifying the major risks, we start with some industry analysis. I must say that over recent years, annual reports of companies that are listed do spend a lot more time and pages on identifying those risks, so that can be a very relevant source of information. And identifying those risks, and again, with a prime focus on what I would call core strategic risks. So some of that comes from what's written, industry reports, and annual reports. You got some public information sometimes on that. But then there's a lot of interviews with management. You get the insight from management, in general, relatively senior management within the organization, and basically ask them big picture what the key risks are and what do they do to manage those risks. So there are some internal process often. I mean, there is often strong management, risk management processes in place, which can be very helpful in understanding that. So I think actually the process that we go through to identify those core risks and to map the relationship between the risks and the functions or the entities that are accountable for is not very different from what you would normally do in a functional analysis. It's just with a deep focus on the core risks and the people that play a role in managing these risks.
Thank you. Maybe a follow-up question to that. I mean, one of the, let's say, criteria for many people when they especially apply certain methodologies that are new to them. I mean, this is now not new in terms of a concept, but I think you apply it in a specific way. Have you tested this either in the context of IPA, tax audit, or a court case situation?
Yeah. So APAs and tax audits for sure. Widely, we actually in some of our cases, it's been the analysis that has helped sort of cross-align or address many points that the tax authorities had about the business model. End of the day, that analysis is very much embedded in the way the company operates and creates value. There are some industries where it's relatively standard, but in many industries, in particular in oligopolistic industries where you got barriers to entry, often taking the form of some high-value intangibles, having that type of analysis in place and being very clear about the interactions between functional assets and risk can go a long way. So in APAs, any tax audit, that usually is helpful, and it helps sort of cross-align or pass a certain difficult point with tax authorities. We tend to do it in the vast majority of transfer pricing analysis that we do, and we believe it strongly helps with regards to the communication with tax authorities. Not yet tested on my side in court cases yet. It'll come up. We need to bear in mind that DEPS is only 5 years old, so doesn't completely meet. Or the OECD guidelines 2017 only 5 years old. But I'm not overly worried about the feedback loop on that.
Sure. I don't want to jump the gun because Rutger is going to talk about a bit of that as well. But I think one question that may be important also for this part is if you apply this to certain industries, take financial services as an example, there sometimes certain functionalities can be so important then you can do a lot of work with one person, for instance, managing of billions of dollars by one person. How do you deal with that? And have you applied this to those kind of industries as well?
Yes. We've applied this to insurance companies. We applied to asset management company, to financial institution. So the key point again to me is this link between the value drivers and the core risks. That's essential in that step. And you're completely right. There are a few industries, and I'm thinking about some hedge funds, for example, where there's a lot in the hands of just a very limited number of people. But they got a big role to play with evaluation. To me, in a way, what we've done here is inspired by what the OECD had done in 2010 when it published its PE papers. I mean, the way we look at risk here is not different from doing a significant people function or key entrepreneurial risk-taking functions. You know, having a look at that, or you can translate that in an intangible view with the DEMPI concept. So having a look at the key people in the organization and the role they may play with regards to managing risks, without forgetting processes. I mean, of course, it's not only people of today, it's also people of the past and all the processes that we put in place that help framing this.
We have one question from Elizabeth Chumburidze. So you.
I don't see the questions, by the way. Do you mind posting that question?
I should just raise her hand, so she has to.
Oh, okay. All right. Please, yeah, you can just give the word to her. I think you have the control.
I don't know. Elizabeth, you here? Okay, I think you can just go on. I think just the hand was for a long time there.
Rutger, do you have any questions for?
Yeah, I have had, by the way, thanks to Emmanuel for the very, very clear presentation. And it is also a little bit confronting us as tax and TPP experts in a way that understanding of risk is extremely important. And is there anything that you would suggest having this as an impact on how to organize risk management in terms of transfer pricing? Because what I see in practice is very often that transfer pricing is considered one of the risks that then is being considered by risk management, but it's also the other way around. So what would you think, would it be an idea if transfer pricing people were just part of the risk management organization?
So I think there's two things here to your question. The first angle to me is, as transfer pricing specialists, because we look at risk and using the 5 categories here or the OECD categories doesn't matter. I think we tend to have a framework built by the OECD, but perhaps on not inconsistent with what I've done here, which can be helpful in framing risk and what they mean. So that in itself can be helpful. And so for that reason, I do believe that people who have transfer pricing background and have looked at the risks in a holistic way, the way it builds with the value chain, can definitely shed light on the risk management processes, at least give some perspective. I'm not saying we're risk managers at all, by the way, but I think we can shed light. If the question is about how to manage transfer pricing risk per se, I have not yet applied that matrix to manage transfer pricing risk per se. What I found helpful in that framework, however, globally, is that it's if you do it properly and exhaustively, it eliminates the risk of major errors, major transfer mispricing, I would call it. That's really what this does from a transfer pricing risk management perspective.
Okay.
Maybe a final question, unless there are other questions from your end, Rutger, to Emmanuel. In let's say discussing this with tax authorities, perhaps auditors, especially in the context of large, I would say, profit split type of arrangements, what was the biggest challenge for you, and how did you overcome that in explaining this and convincing them on that they should be following this? Yeah,
no, the biggest challenge is that, especially I'm thinking about the some of what we do here sort of leads you to a form of profit split analysis, not a global profit split, but a transactional profit split analysis. And there, the question is, how do you get your split factor to take into account the proper risks and to map that? And I think here the main difficulty is you can be exactly right, but that tends to be super complex. So often you have to sort of simplify a few things in your residual profit design. And in doing that, you often make implicit assumptions about which entity is assuming which risks. It's not a huge deal when the core risks are strategic and marketplace risk, and you're very clear about the way these risks are handled within the organization. It can be more complex when the risks that you're talking about are not that well defined, and it's a bit less clear as to what's happening. But yeah, that's what I would do on this one.
Thank you. I think we might have one question from David van Straten. He's asking, what is not quite clear to me yet is how the focus on risk and control over risk relates to the analysis of the use of assets as part of the functions, assets and risk analysis. Yeah. Could you elaborate on that?
Yeah, so there are several things here, but typically if you're talking about a core risks, core strategic risks that may require identifying which are the assets, including tangibles and intangible assets, which are behind that risk, which are at risk due to that risk. I would say that. So the link is there in the first place. Then, if I'm focusing, just for the sake of answering that question, to give an example, if I am focusing on strategic risk, let me take an example of one industry. Let's say it's a luxury goods industry. The core strategic risk is the ability to develop products that are suitable for markets which people like, and you get large volumes impact and so on. What's at the heart of that risk? It's probably there will be a relationship with the type of marketing efforts you do, the type of investments you made centrally, the artists that you'll be recruiting to do that. So to me, there will be a link between the risks, the strategic risks, and the intangibles that you've got behind, which are not only protected intangible, but also know-how and processes that you've got there. So that's the way I would make the link between, in that case, make the link between the strategic risks and the intangibles. I think it's kind of easy on the luxury goods industry, where obviously strategic risk, you don't have the right collections. How do you do that? Well, build the right collections, and that requires developing the right intangibles, investing in intangibles and investing properly in intangibles.
It seems like in the end, it again goes back to the people's functions to some extent.
Yeah. It's not exclusively functions. You're right, but in my mind, that's more or less the way the OECD 2017 version has been framed. There is a lot importance given to functions, and I think it's perhaps a little, sometimes is not the only thing. We should not over focus on functions, or sometimes when we say functions, we should also have in mind functions of the past, not necessarily functions of today. When you deal with intangibles and strategic risk, maybe these are some actions that were taken 5-10 years ago that materialize today and that we benefit from. But yeah, the OECD is definitely putting the link on the functions. The process we've got here also has that in mind too.
Right. I see no further questions for now. I think it's a good time to give the stage to Rutger. Thank you again, Emmanuel, and I think we will be back with you after Rutger's presentation.
Thank you.
Thank you, Rizan, and thanks, Emmanuel, again. I'll share my screen. Hopefully that is visible now.
Yes.
Yeah, I'm going to talk to you about how to support risk analysis with company data. And I think Emmanuel pointed out how important the concept of volatility is in analyzing risk. Parties enter a transaction because they expect this transaction will benefit them. It is the volatility, so the extent to which the result deviates from the expectation, that determines the level of risk involved in a transaction. Now, the interesting thing about volatility is that it can be measured and quantified. In this session, I will touch upon how to use quantification to measure risk and how company data can be used to support such quantification. I will do so in a case study. Suppose that we have an energy company, and that energy company considers an investment in an offshore gas field project. A geological survey has indicated that the offshore gas field contains about 5 billion cubic meters of gas, and to extract the gas from the field, the company must make a capital investment into a gas production facility, which will cost it about 120 million, comprising of 100 million for the facility itself, so the production facility, and 20 million for a transportation pipeline. The energy company contemplates to separate the facility for the gas reserve. So that means the facility would be structured in a separate production company and facilities company that would produce the gas on behalf of the energy company. And the energy company owns the license to operate, but the facilities company would in fact do that with its capital investment. And then the transfer pricing question clearly is at what price that production service by the facilities company should take place. Now, before considering that question, we must first understand, in line with what Emmanuel pointed out, we must understand the gas exploitation life cycle, and that comprises of 6 parts. One is, well, clearly one has to have a gas reserve. And finding a gas reserve is not necessarily easy, but suppose that we have it already in place. The only thing is that we don't know how much gas is available. The second is that we have to build the facilities. Third is that we start producing. Fourth is that we transport it. Fifth is that we sell it. And finally, we have to clean up the pit once the production is terminated, which is increasingly an important thing. So the entire gas exploitation life cycle is the 6 steps that we see here. And the interesting thing is now each part of this life cycle has its own risks, and to understand those risks is important in order to also think about how to allocate and quantify and price them. So let's consider the overall risk profile of each of those steps. You see the icons. The first one is the gas reserve, and the volume of gas reserve. Yeah, there is an expectation that there will be 5 billion of cubic meters available, but well, geological research has also shown that it could be 3 billion, but also 7 billion. We simply don't know. The second thing is capital expenditure. So we have to have the facility in place, and we expect there to be a 100 million layout of capital expenditure, but that is clearly also subject to a number of risks. Bad weather may delay the construction offshore significantly, sometimes with even more than 6 months, in which time the company must pay day leases to the vessels of more than 100,000 euros a day, and planning mistakes may also increase capital investment. If things go wrong, CapEx could run up to 150 million. So the range of cost here is between 100 and 150 expectation. Well, clearly also operating expenses are far from certain. Maintenance may be needed more frequently than expected. Certainly at sea, unexpected repairs may be required, and day rates of maintenance vessels are again volatile. Well, then gas prices, the sales at which the price at which the sales takes place. Well, as the Ukraine crisis has shown, market can be extremely volatile. And at the moment of investment, let's suppose that the company expects the price variation to be between 100 euros and 200 euros per 1,000 cubic meters. And then finally, the abandonment expenses, so the cleanup expenses, well, they are now to be expected for 40 million, but you have to realize that abandonment takes place in let's say, 10 to 12 years, where the environmental requirements and regulations can completely different. Prices, you don't have an idea on that long term about prices. So the expectation is that it could even double in that period of time. Now, given that all these risks that have been considered to make a decision about this investment, given all those risks, the expectation is that the net present value of this whole investment is 136 million euros. But if everything goes wrong, it may be the net present value may be just minus 70 million. But if everything goes right, then we might end up with a huge value of 425 million. As mentioned, the energy company considers unbundling the facilities in a separate facilities entity. So it would actually put down the facilities and operational risk into this facilities company. It would do so by arranging what they call a tariff, a price per 1,000 cubic meters of gas produced. So it would charge a tariff, and that tariff will result in fact a part of that volume risk is now also shifted to the facilities company. By unbundling the production activities to the facilities company, energy company will also shift the risks clearly of part of the production life cycle. And the idea is that 15 euros per 1,000 cubic meters is charged. So thus not only the capex risk and the operating risk is shifted to the facilities company, but also the volume risk. Well, the first question before thinking about quantification of the risk involved in this scheme is how and what of the source of these risks are. As Emmanuel pointed out, it is important to understand that, and therefore I will also use the matrix that is presented by Emmanuel. So on the horizontal axis, you have the source of risk, the external or internal source. And we also have on the vertical axis whether there is an upside or only a downside to be expected. And the place on the matrix will also help us determine how risk should be allocated between the energy company and the facilities company. So let's first just plot risks in this matrix. Well, the gas volume is an external risk, and the reason is very simple. It's in God's hand how much gas is available, and it is not in human action. We cannot produce gas. We can only extract gas that is available. Well, capital expenditure risk is partly internal, partly external, as we described. Bad weather conditions are external risk, but good planning, on the other hand, will have a positive impact or a negative impact if you do bad planning on capital expenditure. Then operational risk. Well, in line with what Emmanuel showed us, is that operational risk typically is internal, and most of the time, well, you can do things wrong and there is an upside, but hopefully good organizations already try to do good things. Then it will be a little bit of a downside of risk. And finally, gas prices. Well, again, gas price has an upside and a downside, but to a large extent is an external risk. Now, what does the plotting of these risks mean for the risk allocation framework? Management of risks that are considered to be internal focuses mainly on preventing the cause, whilst management of external risks focuses more on the managing the effects of the risk. So, if you look at the management, what this matrix will do for the approach to risk management is that external risks will typically manage effect, while internal will sort of prevent the cause of the risk to materialize. So the energy company can try to manage the effect of a gas price volatility, for example, by entering into hedges, but it cannot manage the cause of the price change. In other words, internal risks, and I think that is important, internal risk lend themselves to functional allocation. If you look at operational expenses and risks, that, well, if you have the functions in place, then that typically is something that can be managed by humans, whilst external lends itself more to a contractual risk allocation. And if we take that into account, what does this whole matrix mean for the unbundling situation? Well, I believe that under the risk allocation framework of the OECD, unbundling should result in risk allocation to facilities company if it has the functionality to manage the operational and the capex risk. So if the engineers who keep oversight of the construction and who operate the facilities, who are doing the maintenance and if they are staff the facilities co, the risk management will be performed by them to a large extent, and thus the risk should be allocated to facilities company. And then the question is the same true for volume risks? We as we saw, a part of the risk that is shifted to facilities company is the volume risk, because it charges a price per unit. And indeed, contractual risk allocation is what happens through unbundling. The agreement that Energy Co will pay a volume-based tariff shifts risk to the facilities company. In case of a lower than expected volumes, and so, for example, if there's only 3 billion of production, then facilities co revenue may not make up the capital expenditure, while in the case of higher than expected volumes, the facility company will make a good return. And it is exactly that we need to analyze. And all of this is the result of a contractual arrangement between energy company and facilities company, because the contractual arrangement basically concerns external risk. And because that is the case, the risk allocation framework, I would think, indeed allows allocation to the facilities company. So my conclusion is that allocating part of the volume risk to facilities company should be in accordance with the OECD risk allocation framework. So let's now turn to the quantification of risks. For that, I would guess that we need to look first at how the risks of gas exploitation life cycle affect the business of the energy company as a whole. As Emmanuel already pointed out, a good risk analysis starts with understanding the risk of the whole entity rather than just looking at the different entities per se. And I think that, Emmanuel and I discussed that before, that is where many things go wrong in the transfer pricing analysis, that people start immediately try to understand the risks of the the particular transaction, whereas you first should start to understand the risk of the energy company as a whole. Now we get a little bit into the quantification part. And to that end, let's suppose that the 6 risks that were described here, that 3 out of 6 risks, they are the most, 3 out of 6, they determine in effect the investment return. And so let's suppose that, and which actually is also in practice true, is that volume risk, capex risk, and gas price volatility have the largest impact on the investment return. And considering that each of these risk is uncorrelated, we can analyze the following investment scenarios. Let's see what you see is here a sort of a risk matrix, and let me explain a little bit how it works. On this horizontal line, we have 3 scenarios for the gas reserve. We have the possibility that there is only 3 billion of gas available. The expectation is that there is 5 billion available, but if everything turns out very well, then we have 7 billion of gas available. These 3 scenarios can combine with the 3 scenarios that we have analyzed with respect to the facilities, the capital expenditure with respect to the facilities. So we expect there to be 100 million of costs, but as said, it could be 150 as well. And that can be the case both in the situation where we have 3 billion, but also if we have 5 billion or we have 7 billion. And the third most sensitive risk factor is the gas price development. Let's suppose we have again 3 scenarios. Then we can have a situation where there is 3 billion of gas, 150 million of capital expenditure, and only 100 gas price per 1,000 cubic meters, which in that situation would mean that we end up with a loss. If everything goes right, however, 7 billion, 100 million, and 200, then we end up with an investment return of a net present value of 425. Now, now let's look at the overall risk profile, because let's start to now also understand how the probability of all those scenarios can be analyzed. And now, well, volatility is the outcome of this, and the quantification in a way is always quite well, it can be complex, but I try to explain it in a very simple way. Let's suppose that we have a box of 100 pinballs, and each ball represents 1% likelihood of occurring in a scenario. So if we now put these balls through the risk matrix of the 27 scenarios, then the most likely path that we expect this to be this path to take is that most of the balls will fall somewhere in the middle. But if we have a good scenario, it could also be that we have that the ball falls into the most right tube, whereas if everything goes wrong, we have a loss and the ball turns red. So and if we do that with 100 pinballs, you would expect the outcome of this investment to be something like this. Most pinballs would fall within, well, in the middle, but if things go wrong, then there may be balls here and a few balls fall there. So this is basically what the uncertainty, there's a certain level of randomness. We don't know what's happening. We can analyze, well, the likelihood of each part of this risk, and add it up, we end up with this. What can we learn from this graph? First, we can analyze what the risk-adjusted value of the investment is. And what is the risk-adjusted value? That's the probability-weighted average of all possible scenarios. For this value, to calculate this value, we multiply the scenario result with its probability of occurring. And now remember that each ball stands for 1%. We have 100 balls, so each ball stands for 1% of likelihood. So we can say 1% times 70 minus 70 plus 1% times minus 60 and 2% times minus 50 and so on and so forth. We add up all those values, we get expected net present value, which is presented here to be 136 million. There is another thing that we can learn from this graph, is also the likelihood that this investment will end up in a disaster. As said, each ball represents 1% of likelihood. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 balls that have turned red because the investment has turned out negatively. So that means that we have 12 out of 100 balls with a profit below zero, and that means 12 million and 12% likelihood that this investment ends up in a disaster or in a negative present value. And the real disaster scenario is the maximum loss of 70 million. So what we know now is what the group risk profile of this investment is. Suppose that energy company indeed, on the basis of all those forecasts and expectations, indeed makes the investment. And it does so by unbundling the capital investment into the facilities company and let it produce on the basis of a tariff. We know now what the overall risk profile is, but what do we know about the allocation of risk? We have to answer that question. And understanding the group risk profile will help us to understand the impact of unbundling. And we can do so by doing actually the same exercise as we did in the pre-bundling situation, so for the overall group risk, and we can do that now for the post-bundling, post-unbundling situation. Let's just take a look at how the risk matrix would then look like. The effect of unbundling, first of all, in principle, the gas price or the gas volume doesn't change. So we still have 3 billion, 5 billion, or 7 billion possibility. But what does change is the second line, where we initially had the possibility for energy company that it would end up with 150 million of capital investment. It now actually changes, and the whole vertical column is cut away, and we end up with zero investment. But that investment comes with a price. So we pay a price of 15 euros per 1,000 cubic meters. And that will have an impact clearly also on the revenue and the profitability of energy company after the unbundling. Let's now see how the balls will fall into the pinballs will now fall into the pinball maze. One of the interesting things is that the gray columns on the left and the right, it will affect how the balls will fall. It simply is not possible anymore that they fall on the left, extreme left, and on the extreme right. So we have a situation where the ball bounces against those profitable or beneficial and less beneficial scenarios. And if we again have all the 100 balls in the matrix, then we would likely end up in this type of situation. What you will see is that even more than in the past of the balls are now in the middle, and less are in the extreme. First of all, certain extreme scenarios are no longer possible, but also the number of scenarios that turn out to be negative has closed down. If we then do again a risk-adjusted calculation, price calculation or value calculation, then we end up, which is logical, with a lower expected value for energy company. Lower, why is that logical? Because it has given up profit potential on the other hand, in return for giving up a loss, but it also has paid a price in the form of a tariff. What it also tells us, we now have a smaller likelihood of energy company ending up with a negative present value. So now only 8 out of the 100 balls, meaning 8% likelihood is that we end up with a negative net present value. And interestingly, the max loss has also reduced from 70 million to 25 million. If we now compare the two situations, then what you can immediately see is that in situation without unbundling, the volatility that Emmanuel pointed out is indeed very important for risk allocation and understanding risk. The volatility of the bundled situation, so without unbundling, for energy company is much wider than in the case with unbundling. We shall also see that, well, negative outcomes have reduced, but also positive outcomes have changed, and more balls are in the middle. So that means that we have created a situation that is more stable and less uncertain, less volatile. Well, after this exercise, we clearly can see and compare the statistics of both situations. And well, they are quite self-explanatory. On the one hand, we have a higher investment in case of a bundled operation, whereas in the unbundled operation, we only have a small investment of the transportation pipeline. The NPV is calculated differently. The max loss and the max profits are calculated differently, and also the likelihood of a loss occurring has changed. So what we actually have done is, first of all, as a first step, we understood the supply chain or the investment life cycle of this operation. The second thing is that we plotted the risks in the risk matrix in order to find out which risks can be allocated where. We understood also the quantity of risk of the overall operation. We understood and analyzed and even quantified the effect of the transaction between the two parties, and eventually would be able to compare those. Well, basically, what I try to establish in this presentation is that through this framework we are able, by understanding but also quantifying the risks involved, we are able to quantify the allocation of risk between two parties. And the exercise that we performed here did something extra, I believe. It allowed us to use the company data about gas reserves, CAPEX forecast, OPEX forecast, and gas price forecast to get a better insight in effect of risk and the effect of unbundling. So in a company that has good risk management, most of these data should be available and are available. And if they are available, the only thing that we as transfer pricing experts have to do is start using them for the purposes of transfer pricing. Well, clearly this is not the whole story. I mean, there's much more to say about it, but this is at least the framework that we can use to quantify the risk allocation between entities. So that is what I'd like to present, and I'm happy to receive any question and answer any question.
Thank you, Rutger. Thank you. This was one of the, I would say, most quantitative presentations that I have ever watched myself in transfer pricing. So congratulations on that. Very well presented as well. Just maybe one high-level question, because this relates to energy industry and capital intensive industries. If I look at 5 steps, there are 5, right? I'm not. Yeah. 5 steps indeed. I think step 1 and 2 would, I guess, apply to any industry in a similar way. What about the step 3 especially? It seems like you are using a certain methodology. Can you apply that to any industry, any company?
Well, not necessarily the same way as I did here, but actually, for example, applying it also in supply chains where the typical supply chain that we see very often with a central entrepreneur and production facilities and sales facilities. We have used them quite often in order to sort of test the logic behind a business restructuring. If you see, for example, that you convert from a full-fledged manufacturer to a tool manufacturer, what you will see is that risks are being reduced, and you can make estimates about what the production would be before and after, and see how your changed business model, how that affects the profitability, and whether there's a logic relationship between the situation before and after. So yes, I think it is applicable, and we have applied it in the past. But well, it's clearly you have to again start all over understanding the risks and the volatility of each of the part of the supply chain. As I guess that also Emmanuel pointed out, hey, you have to understand all those, otherwise you'll do. It is not just a simple click the box or check the box type of exercise.
Very good, very good. And maybe a follow-up question to that. I mean, this is not the simplest analysis that you see in transfer pricing. It has it's very solid, but it's also complex. How do you deal with that in dealing with your stakeholders?
Well, the interesting thing is that, to be honest, we tax and transfer pricing practitioners have a different perception on complexity, I guess. We find our own expertise not necessarily complex, but our customers do. Whilst, as I have I've experienced, if you talk to business people, they love this. And the reason being is that we are now not talking about OECD guidelines anymore, but we're talking about their own business. I remember having done a similar project for a gas company as this, and one of the reservoir engineers said to me, well, can I offer you a job as a reservoir engineer rather than as a transfer pricing person? So I clearly didn't do that, because strangely enough, as a transfer pricing expert, you earn more than a reservoir engineer. But it is interesting to see that you have a connection through business, because this is what they understand.
And could you say the same for tax authorities and the judges, if you would ever come before them?
Yeah, well, the thing is that, as I guess I would do, you have to take people through a lot of steps, which is always difficult if you explain a new concept, or not necessarily new concept, because actually I've stolen this from the oil and gas industry, which is better stolen than better good steal than a bad invention. So I didn't invent this at all. The only thing that I applied it. If you have tax authorities who are willing to take time to go through this, it is helpful. And by the way, one of the things that is important, because you quantify in the way that I presented here, the model that you use is also quite robust. And that means that any model you can tweak a little bit. That is, I know. And the first thing that I always ask, if there's someone presenting a model to me, then I say, where did you tweak it? But the interesting of a good model is that the scope for manipulation also reduces. So I remember having sat with the Dutch authorities about a model like this, and we were sitting together like 3 hours, and we went through the model in detail for 2.5 hours. And then one of the tax inspectors said, well, did you also include this into the, and then he said, well, I don't ask because the answer probably will be yes. And I said, yes, it is. And I can show you here. So it is, once people are receptive to it, it is convincing, but you sometimes, and that is absolutely true, you have to overcome a certain reluctance because one, people may not necessarily understand. And if you present it to the tax authorities and present complex things to the tax authorities, they initially might think, hang on, how is it tweaked? And I cannot lay my finger on that tweak. And that is the disadvantage of any model that you present. So you have to be extremely transparent, be open for an audit on the model, whatever you do, in order to, and that also, well, this allows you to really tweak, because if you do, and people find out, it is disastrous.
Very well, very well. So, well, I have a few more questions, but Emmanuel, if you have any questions for Rutger, please jump in, or I'm looking at the audience as well. If they have any questions, you can post your questions in Q&A as well, and I will pose them to Rutger. Go ahead, Emmanuel.
That is very clear to me, so thanks very much, Rutger. Extremely clear. So, Rosanna, over to you for more questions.
All right. Well, there are enough questions with me, so I'll continue until more questions pop up from the audience. At the beginning of this presentation, I kind of, when I talked about function analysis, I said, well, function analysis was done, but risks were kind of forgotten. When I said to you, Rutger, I'm not saying that that's what you have done, but I felt a little bit the other way around, that, that you forgot about people functions. How do you, you refer to the gas reserves being act of God and so on. But of course, there must be people behind the operation. Can you maybe?
Oh, absolutely. And I think that's you touch upon a very, very important question. If you talk about risk quantification, then, and specifically if you do it based on sort of randomness, Monte Carlo type of approach, which is done here, you cannot do that for everything in per se. So what you typically, and that is, by the way, and that's why I love the risk matrix that Emmanuel presented, because it really helps you to see where there is externality or external source of risk and internal. And if you have an internal risk, you simply cannot apply any randomness, because people do things. Yeah, you can say, well, there's always a randomness in people doing things wrong or right, but that good risk controls in a company, in an organization, will really affect how you do your business. And doing things wrong and approach them randomly I think would be a mistake. Yeah? So any analysis, and I went a little bit easily through it, but you really have to do that more in depth through that matrix that Emmanuel presents, which I think is brilliant, because if you go through it, then you will also, sort out which risks indeed are acts of God instead of things that can be managed. And having said that, there is always another thing to risk. As I said, well, you can manage the effects of risk if they're external, but even there, the choices have to be made by humans. So if I hedge, then the hedge as such is a risk management activity, and that risk management activity has to be performed by someone. But there is always this residual risk that is, to a large extent, dependent on randomness. And if, as soon as we enter that stage, then quantification becomes a much easier, I would, because it still is a complex thing, but it's more logical.
Yeah. I guess, especially in the industry you're discussing right now, you have also licenses in certain countries to, for instance, operate in those countries. And once those licenses are there, it costs money, but you don't have, you don't need a person to maintain that license for, let's say, 10 years or 20 years. And I guess that's also a difficult question to answer, right?
Absolutely. Yeah.
Another question that is, I think, very important from my perspective is...
sorry, we have one more question. Maybe you would, in sake of time, to go for that.
Elizabeth? Is that,
Yeah, the question is, how do you overcome discussions on the assumptions of the model, for example, expected capex with the Dutch tax authorities? That's from an anonymous attendee.
Yeah, well, there we touch upon an interesting thing, which basically boils down again to the question: to which extent have you tweaked the model? And that is also the reason why I started discussion with Emmanuel about how should we incorporate transfer pricing people into the risk management organization, because the risk management organization looks at risks not in a manipulative way. I mean, they really want to understand the risks, and they just don't want to manipulate the outcome of the risk or their risk analysis to be, well, manipulated into a certain direction. No, they want to understand the risk. So that is also the reason why I think that transfer pricing and risk management should be much more closer to each other in order to also to avoid that this happens, because what you must avoid is that this is becoming a sort of a separate separate exercise that doesn't have to do anything with what the company does. And that's exactly the reason why I think that transfer pricing and specifically when it gets to risk and risk allocation should be much more integrated into the risk management organization than it currently is.
Excellent. Svetlana, do you want to answer the question? I saw it on the chat. Do you have any views on that?
No, I just,
okay.
Since it's
right.
1 minute left, I just wanted to...
We're coming to the end of the presentation.
Yeah.
I personally would like to thank Emmanuel and Rutger, because I learned a lot from this presentation. And back to you, Svetlana, to close it off.
Yes, thank you so much to our speakers and Rezan for moderating. So we finished our third webinar in the series and also the series of webinars. Thank you so much for every speaker and those who attended, actually all three. We also have those people, and yeah, it's great to have you on board. And we will start next year with, we'll have now a break, maybe on 2-3 months, and then we'll start next year with the next series, and we plan it to be on intangibles and DEMPI functions. So another very interesting and practical topic to deal with. And also many people already know again and also registered, but we also will be very happy to see you in Amsterdam on 9th of December for our opening conference, which will be on the interplay between transfer pricing and EU law. There will be many topical issues discussed, and more gladly for us, more and more things are coming from the European Commission side or from the court side. So I will have lots of things to deal with. And yeah, so I'm grateful to Manuel de los Santos, Isabel Verlinden, Richard Collier, Romero Tavares, Maximo Desi, Charlie Lincoln, Rutger Hafkenscheid, Emmanuel Llinares, Rezan, and yeah, so for basically having this webinar series, and to all our attendees. And with that, we are on time to close this webinar as well.
Thank you.
Great, thanks.
Thanks.